Booz Allen Hamilton is a staple of government contracting, but right now, the firm is navigating severe macroeconomic headwinds. The federal procurement landscape is experiencing sharp turbulence. Ongoing spending reviews by the Department of Government Efficiency have actively delayed funding across civilian agencies. These delays triggered a financial paradox in Booz Allen's fiscal year 2026 earnings. The company's top-line gross revenue contracted significantly. This table summarizes Q4 and fiscal 2026 results. Notice the top line. Total revenue shrank 6.4% to $11.2 billion. Look further down the column. Profitability expanded. Adjusted diluted earnings per share increased 2.5% for the year and 10.6% in the fourth quarter. Earnings expanding while revenue shrinks is rarely an accounting anomaly. Here, it is the direct result of aggressive corporate triage. Faced with a federal spending freeze, management did not wait for conditions to improve. They actively restructured the firm's legacy operations to survive. To protect the firm's 11% EBITDA margin, leadership is executing a strategic pivot, moving away from legacy civilian work toward a new model built on AI and defense technology. To understand how they protected those margins, we must isolate exactly where that contraction originated. This operating data table breaks down revenue by customer type. Focus on the civil segment at the bottom. It contracted 22.1% annually. Comparing fiscal 2025 to 2026, we see a $922 million gap. Nearly $1 billion in civilian revenue evaporated in 12 months. The first major catalyst was the Department of Veterans Affairs. Booz Allen saw the roll-off and lost renewal of the massive PTEMS contract. PTEMS was a high-volume task order under the T4NG vehicle. Losing it created an immediate 300 basis point headwind against the company's total corporate growth. The second catalyst compounded this top-line bleed. DOGE-mandated freezes on other large-scale civilian IT programs. Much of the civilian work operates on a time and materials contract structure. The government pays the contractor an hourly rate for labor plus the cost of materials used. When administrative spending halts, billable hours drop immediately. Time and materials consulting is uniquely vulnerable because every hour not worked is a dollar not earned. The top-line crash was not a failure of contract execution. It was the mathematical consequence of heavy exposure to a frozen civilian IT procurement environment. Executive management immediately recognized the severity of this unprecedented civilian agency freeze. CEO Horatio Rosansky and his team initiated an immediate triage strategy. They chose not to carry excess capacity waiting for federal budgets to unfreeze. This headcount table reveals the sheer scale of their response. Between 2025 and 2026, total personnel dropped 12% to 31,500. Looking below, customer staff dropped by nearly 4,000. These cuts targeted primarily non-client-facing and low-margin civil IT support roles. Removing low-margin labor immediately eliminates overhead and billable travel expenses without significantly denting core profitability. The balance sheet proves the effectiveness of this maneuver. Despite losing nearly $1 billion in civil revenue, Booz Allen maintained a flat adjusted EBITDA margin of 11.0% for the full year. This rigorous cost discipline allowed their Q4 adjusted EBITDA margin to expand by 50 basis points. Management successfully traded low-quality revenue volume for high-quality margin preservation. They right-sized the firm for a tighter federal budget. This restructuring serves as a proactive strategic pivot away from traditional human speed consulting. The firm is transitioning into a machine-speed, AI-native defense technology prime. They are replacing models that map headcount volume directly to revenue with automated product deployments and software licenses. The firm deployed its $951 million in free cash flow to fuel strategic acquisitions. By acquiring Defy Security, Booz Allen bought established, product-driven revenue streams that scale without requiring a massive influx of new personnel. They are also investing heavily in internal R&D. They recently launched the Velox Reverser, an automated cyber defense tool designed to replace manual threat analysis. And in the physical realm, they partnered with Anduril Industries to integrate zero-trust cyber and command and control capabilities directly into hardware at the tactical edge. The unit economics of this pivot are clear. Software and hardware integrations inherently generate higher profit margins than billing individual hours for legacy consulting. Booz Allen is weaponizing the cash flow from its legacy consulting business to buy its way into the top tier of outcome-based defense technology contractors. This tech pivot relies on stable capital. If the civil business is still facing near-term headwinds, investors need to know what protects the company's forward cash flow. This operating data sheet shows Booz Allen's institutional safety net, a record total contract backlog of $38.1 billion. The most critical metric here is the trailing 12-month book-to-bill ratio, which sits at a healthy 1.1. A book-to-bill ratio over 1.0 proves the company is winning new, funded contracts faster than it is burning through existing ones. This massive reserve of funded and unfunded backlog guarantees that national security demand remains structurally intact. It heavily insulates the firm from ongoing civilian agency volatility. With a leaner operational foundation in place, management issued forward-looking expectations for fiscal year 2027. This financial guidance slide outlines a return to top-line growth. Management targets revenue between $11.2 and $11.7 billion, representing 0 to 4% year-over-year growth. Profitability projections remain highly durable. Notice the free cash flow target, expected between $825 and $925 million. Management openly admitted that fiscal 2026 was their most challenging operating environment as a public company, but their survival mechanic was incredibly precise. Rather than subsidizing a failing civilian business, they surgically cut it to save the corporate margin. Booz Allen Hamilton has entered its next fiscal year with a portfolio that is significantly less reliant on traditional civilian IT support. The market is now evaluating the firm based on its ability to scale high-value tech products rather than its total number of billable hours.